Hey Nate, how's it going?
It's going well, Derek.
Busy day?
Well, it is a busy day, and we've been fielding a lot of calls, as you would imagine. And so I wanted to kind of be proactive on this, and this is something that I want to do a little bit more in the future for good reasons, for basically market news, so that we can record this and broadcast this out to clients, and so they can get up-to-date information. We can be a little bit more reactionary as far as how we communicate with our client base and our listeners. So wanted to take this time to kind of address the main question, and that is, why is the market going down? Why has the market essentially been a steady decline from January 1st till present? What has changed in the market from December to now? And so if you don't mind, Derek, I'm going to go ahead and just address, probably that's the main question that people might have.
Yeah.
Of course. So the stock market is a forward-looking instrument. And so it doesn't necessarily care about what's going on today. It's more concerned about where the prospects of growth are going to be in a month, and 2 months, and 6 months, and a year down the road. So knowing that it's a forward-looking instrument, what really is driving the market right now is the interest rates. And not necessarily that interest rates are rising or declining right now, but the prospect of rising interest rates in the future. So let's backtrack a little bit. If we go back to the fourth quarter of 2021, the Federal Reserve, which is in the United States, that's the central bank, that's the central authority on monetary policy. The Federal Reserve hinted at the fact that they would likely see 2 to 3 interest rates increases in 2022. So why do they do that? Why do they want to raise interest rates? Well, they're paying attention to inflation because the Federal Reserve essentially has a dual mandate. And that dual mandate is it wants to keep maximum sustainable employment, and it also wants to keep the price stability in control, meaning that it doesn't want the prices of the goods that we buy to rapidly rise or rapidly decline. They want relative price stability. The way that they control the price stability or the inflation rate is through interest rates. And if the economy is running too hot and we have inflation getting out of control, well, then the thing that it does is it raises interest rates. The reason it raises interest rates is, and so why does that work? Well, because it makes the cost of business become a little bit more expensive. So if, Derek, you and I make widgets and we want to go to the bank to get a loan because we want to expand our widget business. Well, if interest rates are rising, it makes it, number one, more difficult to get the loan. Two, we would have to ask the question, do we produce enough widgets to pay for the interest if it's a rising interest rate? So the Federal Reserve will intentionally try to cool the economy off in periods of high inflation to bring that inflation back down under control. And it will do the same if we hit a rough patch. So anytime that we are, the economy is becoming sluggish, or if we're entering a recession, the move that the Federal Reserve does is that it decreases interest rates because it wants to make the cost of business cheaper. It wants businesses to go out there and reinvest in themselves, to hire people, to run a marketing plan, to build a building or buy more equipment. So why am I saying this? The fourth quarter of 2021, the Federal Reserve said, we see ourselves raising interest rates 2 to 3 times in 2022 to kind of rein in this inflation. So since then, there are some big banks that have come out and they thought, I don't know if 3 interest rate hikes is going to be enough. Goldman Sachs came out and said, we anticipate 4 interest rate hikes in 2022. And then JP Morgan, who is the CEO of Chase Bank, said, I could see as many as 7 rate hikes in 2022. So that's where we're at right now. The market is a forward-looking instrument, and it's trying to, without knowing exactly how many interest rate hikes are going to be there, it's trying to price in what that is going to be.
Yeah.
And so,
sorry. No, go ahead and finish your thought.
So I think that's what we're at right now. This volatility that we're seeing is the market is anticipating the worst. It's anticipating way more interest rate hikes than we anticipated. And so we'll find out if I'm right or not. There gets to be a time, volatility is neither good or bad, right? Volatility is just the market trying to find its correct level of where it's at. We don't want it to get too high. When it gets too high and it's not supported by something underneath it, by the data that supports rising, then that becomes a bubble. we also eventually get into what's called oversold territory, which means the market's too pessimistic. And you begin to look around and you see companies that you love to own a year ago are now at their lowest point as they have been over the past 52 weeks. So it becomes buying opportunities. And investors look around and they say, oh, the market is oversold at this point. Things are too cheap. And they begin buying again. The selling is reversed by buying, and then you see the rise in the market again. And we saw this. Anybody who was invested in March of 2020 saw this. We had a rapid sell-off when the stay-at-home orders were issued, and we were concerned how long this was going to be. Were we going to be, would the economy be shut down for 3 weeks? Would it be shut down for 3 months? Would it be shut down for a year? And then once we saw that things were coming back and that businesses were opening back up, the market recovered pretty quickly. So it was definitely in oversold territory in March and April of 2020. And I think we're nearing that point now. We'll see if I'm right or not. Just because the market is oversold does not necessarily mean that it's going to turn around right away. It could stay in oversold territory for a period of time. But what makes me believe it's in oversold territory is just to look at some of the stocks out there. Some of these high-flying stocks that are reporting amazing growth numbers, and nothing has changed with them as a company. They're still the same company, producing the same products to the same people who can't get enough of them. We're seeing these at a point again where you'd have to go back a year or even 2 years in some cases to be able to buy them as cheaply as you can buy now.
Yeah, I think the main point there that I wanted to expand on was the point that volatility is not good or bad. Like if you use volatility as a reason to buy or not to buy, it's probably not the best metric to look at, because if you look at a company like Amazon, who is one of the staples of the American economy, there's been times in its history where it's lost 80% of its value in a relatively short amount of time. So if you just look at volatility, you would say Amazon is a bad investment. But if you look at the fundamentals of the company, it's like you would conclude the exact opposite.
Yeah, and as a company becomes more mature,
Or an asset,
yeah.
Any asset.
But yeah, as an asset or as a company becomes more mature, you tend to see less of that volatility. So, for example, NVIDIA is a company that you and I both love, and Crosby Advisory loves, and we recommend it as a growth stock. It's seen quite a bit of volatility here in the past month. That doesn't make it a bad investment. It just means that, and I think this goes back to any time that you're investing in the stock market. I think there's some tools that you can put in place that make you act appropriate for the time. The number one tool is to remember your time horizon. When do you foresee needing this money to create income for yourself? Or when do you foresee needing this money to buy a vacation home, or whatever the reason was that you intended to invest? And if your time horizon is 3 years, 5 years, 10 years down the road, what happens now has no impact on that. And again, I would take you back to March of 2020. We ended up finishing the year in 2020 up significantly. So that decline that happened in March had no bearing. And actually, you would make the case, actually, maybe that decline spurred the growth that happened going forward. So number one, we want to keep our time horizon. If we're invested for 3, 5, 10, 15 years down the road, I think we want to be buyers at this point in time. The other thing to remember is the allocation. So if I look at, I can't speak for all investors because I don't know exactly who's on this podcast and if they are clients or not, or if they just picked it up as informational pieces. But if you look at the Crosby Advisory clients, most of them are not 100% stock in their portfolio. They own gold, they own real estate, they own bonds, they own commodities, they own other asset classes. In the media, its attention will be on stocks because, let's face it, they are probably the most exciting to follow. But if I look at the average portfolio, so the S&P 500 since January 1st is down roughly about 10% to date. The NASDAQ is down roughly about 14%. But if you were to take the average Crosby Advisory client, whether they're in a moderate strategy, a moderate high, aggressive, we would see a percentage that is less than that. And that's because we own other assets classes, other assets that are, if you look at gold right now, gold is holding its ground. Commodities have done well through this whole inflationary period. So there's things in this account that are rising or holding their ground as stocks are declining, which is the reason why the account as a whole does not experience the full brunt of the U.S. stock market.
Yeah, that's another really good point. So I just have some other questions here that you've been getting asked probably a lot today, and other questions that have been asked. You kind of touched on some of these here, But yeah, the first one is just an overview of why this is happening in the market today. And two is should people be worried? Like not so much. I guess you can give your thoughts here, like long term and short term. Like, what's kind of your outlook for stocks going forward? Should people be calling their 401k advisor and telling them to cash out? Like, how should people be feeling now?
Well, I think that money is a very emotional subject, right? Because our brains are hardwired, I should say, to keep us safe. And so it's our brains spot danger, and it will see danger, process danger much more alertly than it will a good time, right? So when we see markets selling off like they have been over the past couple of weeks, those flashers go off, right? This is my money. I'm concerned about this, and they should be, right? These are retirement accounts. These are in many ways lifelong works savings that have been in place. But I think we need to go back to our time horizon. Over time, the stock market, which we're going to talk mostly about right now because that's what's in the media right now, the stock market goes up and to the right. And it has its periods of time when it goes through its volatility and it finds its natural level. And volatility can be caused by a couple of different reasons. What we look for is market risk, or do we look at systemic risk? So what's the difference there? Market risk is the natural rise and falls of the US stock market. So when we sit down in our January planning meetings, we anticipate the market to have a decline of at least 10% once or twice during the course of that period of time. That's called a correction. And that is normal. That decline of 10%. So right now I mentioned the S&P 500 is down roughly 10%. That's normal. We should experience that, or we should expect that several times within the course of a year. That's natural market movement. That is not systemic risk. Systemic risk is there's something broken in the underlying economy. So systemic risk would be 2008, the housing market crash, the subprime loans that were out there. That was a systemic risk, and that caused a deep, deep recession. I don't believe right now what we're at is anything systemic. We're seeing the market try to figure out what level it should be at based on what interest rates are going to do over the next 12 months. And the problem it's having is it's unknown. They don't know how many interest rate hikes they're going to have. So to answer your question, Derek, or the question that was asked to you, should you be concerned? We're always concerned about our money. Am I concerned about our portfolios? No. I think what we're seeing is natural market fluctuation, and it's nothing to be alarmed about.
Yeah. I think another good point you made right there is like just the comparison of what's happening now in 2008. Like I think these are drastically different circumstances. Yeah, I don't think there's any systemic risk like inflation. People should, or maybe investors should be worried about inflation because the Federal Reserve might be more prone to raise interest rates in the near term. But I think demand is so strong in the economy. Like we're coming out of COVID, and like the balance sheets, like some of these companies that we're watching, like they're such on solid ground. I don't think monetary policy is going to change that one way or the other. It might change outlook for like GDP growth, like macroeconomy stuff. But I know we keep using NVIDIA as an example, but they literally can't keep their chips on the shelves. Like every chip that's coming up, and the AMD, the Advanced Micro Devices CEO said the same thing. Like every chip that comes off the assembly line or however they make them, it has a buyer already. Like they literally can't keep these things.
Yeah. Think about the years prior to this. So we were in a period of historically low interest rates for such a long period of time. And now we're at the point in time where that environment's going to change. So the environment's going to change. What the stock market likes is known. Good or bad, it likes the idea of knowing what's coming ahead because then it can plan for it and companies can plan for it. So I think what we're going to see until the interest rates happen is it's pricing in worst case scenario. It's pricing in many more hikes than what may actually happen. And until we have some sort of a known period, we're going to see some volatility. Again, I believe the market is oversold. That doesn't mean it's going to turn around today. It just means that I think that there is some real value out there if you're a long-term investor. And what I mean by long-term investor, we've got a time horizon of 2, 3, 4 years down the road.
Sure. And I think like if you look historically, like rate hikes are in the news, but I can't see it. I can't imagine a scenario where the Federal Reserve comes out and raises rates to where they even have been historically. Like, I think money is still going to be cheap, relatively speaking, compared to, because I mean, if you look at inflation in the 1970s, early 1980s, what the Federal Reserve had to do to stamp out that inflation was like raise interest rates over 10%. We're not in a scenario where that's feasible. Like you would, like the Federal Reserve is too market conscious. Like they care too much about stocks. They care too much about like just the economy as a whole. They're not going to voluntarily bring us into recession if they didn't have to. So I
Yeah,
don't think we're in that situation. I think money will remain relatively cheap.
I agree. The thing that that is interesting is that I would agree that the Federal Reserve does pay attention to the market, right? And historically, that's not its job. Its job is to
Right.
maximum sustainable employment and to have price stability there. And now that it's paying attention to the stock market, you could argue that's good or bad. But in recent history, the Federal Reserve has been a backstop for the market.
Sure.
So what we're seeing now, I guess the point of what I wanted to do put this out there is it's been some time here since we've had a market correction. These historically are normal. And again, I would expect them several times a year. I would expect swings of 10% several times a year. Normal stuff. What we look for is there's something underlying to be concerned about. And as I view it right now, the thing that I see in the market is it's trying to find a level that it should be on based on the interest rates that are coming in the future. Apologize, guys. Coming in the future here. And the fact that it just doesn't know that yet is why we're seeing a little bit of sell-off. It's pricing in worst case scenario.
So just another question here. What are you doing with your personal investments? How do you manage your own portfolio in times of volatility like we're seeing now?
Yeah. And so I have to be careful because what my personal investment strategy is not necessarily
right. Good disclaimer.
somebody who's at 65 and taking income from it. But so I've got decades ahead of me as far as growth, right? So I also understand like what I'm investing in, right? So there's a portion of my portfolio in retirement that I'm in long-term S&P 500, NASDAQ type stuff, and I'm dollar cost averaging that. And I really don't care what happens on a day-to-day basis or a month-to-month basis. There is a portion of my portfolio where I'm buying individual stocks. I own, full disclosure, I own basically every asset class that you can own. I own stocks, I own some bonds, I own real estate, both physical and through real estate investment trusts. I own gold, both physical gold and gold that we would purchase through a gold trust. I own commodities. At this stage in my growth trajectory, or I guess my strategy, I'm majority stocks. And because historically speaking, stocks give us the best opportunity to outpace inflation. Inflation, as we have talked about ad nauseum, is the consumer price index came out. The Bureau of Labor Statistics said it was at 7%. So I got to be in something that has the ability to outpace that long term. So I'm buying stocks. So without getting into individual stocks on this podcast, I'm buying stocks that I've loved for the past year, 2 years, 3 years, 5 years that are at now discount prices. And the move that I would make if I were investing in individual stocks is I would look for value. So these companies that, the Microsofts, I just said I wasn't going to get into it, Apples, the Home Depots, these stocks that have been driving the NVIDIAs that have been driving the market forward that I can now buy cheaper than I could have bought in the past year or 2 years. I would be looking to add those as long as my time horizon was appropriate. If my time horizon is 6 months from now, 3 months from now, no, I wouldn't own stocks in general because those are long-term instruments.
Sure. So just maybe take a second and maybe explain to people what we've done with Crosby Advisory portfolios. And then I know dollar cost averaging is a part of that strategy. So maybe if you could touch on dollar cost averaging for people that maybe don't know what dollar cost averaging is.
Yeah. So this is a great question. So we knew this was coming, right? We knew they telegraphed at the end of 2021 that the Federal Reserve would begin raising interest rates. So we began making changes to the portfolio. We got rid of long-term bonds. And we replaced them with shorter duration bonds. Shorter duration bonds are less affected by interest rate hikes. Inflation's been a problem for over a year now. So commodities have been a part of our model for quite some time. Commodities are still in our model. Gold, particularly, we increased the percentage of only because we did anticipate some volatility as the market would try to find its natural price where it should be at with these interest rate hikes. So gold historically has gone up when stocks have had some rough patches. The thing that we're looking at is gold is that we will keep a close eye on is gold doesn't necessarily shine, pun there, gold doesn't necessarily shine in times of dramatic rising interest rates. And the reason for that is if I'm an investor who is looking for relative stability, I could own gold or I could own a bond. The bond pays me interest, the gold does not. So oftentimes a short duration bond becomes more attractive in times when I've got a potential to earn a little bit higher interest rate on that. So we did increase gold a little bit in the portfolio. We're paying attention to that. You're going to see in your investment models that you've got the consumer staples index through XLP, which historically has held its ground pretty well. Consumer staples are a defensive play. We added consumer staples not just because of the volatility, but because they were the second worst performing sector last year. So what we tend to do is we take the worst performing sectors of the previous year and we add a little bit of those to our portfolio going forward. Why? If you go back as far as you want to go back, that's an awesome strategy. The analogy that Derek and I sometimes use is if we're going to Vegas to gamble, which I don't consider investing gambling, but essentially we want to put the odds in our favor. And historically speaking, if you take the worst two sectors, which were the utility sectors, the consumer staples, and then the other tilt we have is the communication sector. I can't remember. Maybe Derek, you can take a look at that, what the worst, third worst performing sector is. But we take the bottom sectors and we add a tiny sliver of them to our models going forward because historically speaking, that has given us a nice risk-adjusted return in the portfolio. So let me backtrack. So I mentioned we're going shorter duration on the bonds so that they're less affected by the interest rate increases. We've added a percentage or two to gold. We did add a percentage to real estate. And the reason we did that was because we like the yield on the real estate to replace some of the yield that we were losing on the long duration bonds. And then the last thing we did in last quarter was we shaved some of the growth stocks. So a lot of whether we were owning individual stocks or we were owning the NASDAQ, which tends to be more tech oriented, we shaved a little bit of that percentage and we took that and we placed it into value stocks that typically trade at lower valuations. There's some safety there. If it's a lower valuation, it tends not to fluctuate as much. And value stocks also pay dividends. So if we're in a period of time where we've got a sideways market or a slightly declining market, we're still getting that yield that's created from the value stocks.
And then also in our more aggressive accounts, we also diversified internationally. We have international real estate, and then we also diversified across market capitalization. So the size of the companies, we added some small caps, which is companies valued below $2 billion. So that's just diversification is really the strategy that we're taking here.
Yeah, and the reason that we added the small caps is if you look at them from a value proposition, and if we measure this by a ratio called PE, take the price and divide it by the earnings per share, then we see that the small caps are actually much cheaper now than what large caps are. So we added that to the portfolio because we saw more value going forward in small caps. Not saying we got rid of our large caps, they're still the majority of our stock position, but we've added that because we did see more value there.
Just those tilts in there.
Yeah.
So, so for people that are maybe a little, this little market correction hasn't been anything catastrophic. It's not 2008. It's not a .com bubble, but for maybe people that didn't like the volatility, is there ways beyond diversifications to mitigate the volatility outside of diversification?
Well, I think that, diversification is the main thing. And if you look at what you want to do as an investor is you don't want to create your portfolio for the good times. You want to create your portfolio for the bad times. What I mean by that is for you to be successful long-term, we need to be able to ride the good times and bad times. And if market corrections don't bother you the least, then I would urge you to likely have, as long as we have an sufficient time horizon, that we're in majority stocks because those will give us the ability to outpace inflation. Historically speaking, at least those have been the best for outpacing inflation. But what I would recommend that if you have not done with your advisor recently is that we actually go through the back tests of how it's invested. And so I like to take our current portfolio and run it over 2008. I like to take the current portfolio and run it over March of 2020. And if you're not comfortable with what you see, the time to make the change is now. And actually, what I would recommend, if somebody is maybe a little uncomfortable with their portfolio right now, don't make the change now. Sit on your hands, let this thing come back. And when it comes back at that point in time, we should make the change.
Yeah.
But I know no other way actually than diversification, because we can, if we look at the models that we have built, whether it's the conservative model or the all-weather portfolio that we have, we can, limit that fluctuation, but you can't get rid of it. The only way to get rid of it is to be in some sort of a fixed investment. The problem with a fixed investment is you're going to get crushed by inflation. And if you look at what annuities are paying, or what CDs are paying, or what savings accounts are paying, those have no volatility, but the purchasing power is getting eroded rapidly with an inflation rate at 7%. So we can limit the volatility by being in other asset classes besides stocks, but we can't totally get rid of it. I think that is, if we're interested in outpacing inflation, to use another term, that is the bone that comes with the steak. We have to put up with some volatility.
Yeah, I think again, that's a really good point. Me personally, diversification is probably the best strategy. I mean, hedging kind of goes along with diversifications, like having hedge positions, like a gold position, having non-correlated assets like laddered bonds, so short duration, long duration bonds. If you want to limit volatility in equities like stocks, you're pretty limited to your strategies. If you want that growth, then you're going to have to have some volatility. Like we said before, volatility isn't good or bad. It is what it is. It's just the bone with the steak.
Yeah. And the types of stocks you own can change that. Obviously, if you're in more mature companies that pay dividends, that have stable cash flows, it's a trade-off. You'll probably get less volatility. We've got that income coming, but we're never going to see those stocks, do 50%, 80%, 100% in a year, like some of the more growth stocks do.
I mean, and there's a reason and not everybody does it. That's another thing too. Like even like Ray Dalio, his famous like all seasons portfolio, it's diversification. That's how he achieves that steady growth rate. It's just non-correlated assets. So when one goes up, one goes down. But the smartest people in the world, like it's not like somebody out there knows something we don't. It's just like the strategy is the strategy, the Warren Buffett strategy of just buying really good quality companies and then just kind of riding the waves, or effectively hedging it with diversification.
Yeah. The thing that I like to do with my portfolio is, because I'm an advisor, this is my job, but I'm also human with my own portfolio. So the thing that I like to do is remind myself what I own. So I'll go back to my investment policy statement. What was my goal? What was my time horizon? And then if I look at my funds, like if the S&P 500 makes up most of my stock portfolio, let's look at those companies that are in there. Apple, the biggest one company in there. Am I concerned that Apple's disappearing? I'm not. Microsoft, Amazon, Berkshire Hathaway. I mean, these are the most innovative and relevant companies in the world. So it's healthy, I think, to take a look at that, what you own, because someone would say, I own stocks. Well, I own stocks is a lot different than saying I own Berkshire Hathaway, I own Amazon, I own JP Morgan. I mean, these are the companies that are ingrained in the American way of life, and these are the companies that will propel America forward as well.
Yeah, there's a big difference. Yeah, when people say I own stocks, there's a big difference between owning Apple, Microsoft, Amazon, Google, and AMC, GameStop. Even like people use like Palantir as like a super, like they're looking for like a crazy return out of that one. So yeah, not all equities are created equal. Another question here. What's your opinion on volatility in the crypto markets? I know you're a crypto investor. You got any notes on that?
Yeah, so I own a small percentage of my portfolio. I have in Bitcoin. And this is not a recommendation for you to go out and buy it. Bitcoin fascinates me from a technology point of view. It fascinates me from the idea of the question of what is money. And so I own it because I want to be a part of that conversation. We talked about stocks being, you have to pay attention to your time horizon. So we would not buy a stock, or we would not buy a stock fund if we planned on using that money, all of the money at least, in less than a year. So the same thing with crypto. So if I'm buying Bitcoin,
especially with crypto,
that's what I was saying.
Yeah.
Bitcoin in my mind is a 10-year, 15-year investment. And even in 15 years, it might not be around, right? There might be something else. So number one, I'm allocating a responsible portion of my portfolio to something like that. This is something that if Bitcoin were to disappear overnight, it doesn't change the way that what I eat for dinner that night. So, and I think that is the key with everything is we want to make sure, understand the risk that we're taking on. In my mind, I don't see that much of a risk with investing in Apple. I could see some potential price fluctuations on a day-to-day, but I'm not concerned if Apple, the company, is going to be here in a year. I'm pretty confident in that.
I apologize to everybody. I did mention this before, but you can also add questions in the chat. But we only have a couple more questions here. We're looking to do this like on a quarterly basis. I think this would be useful to have these types of discussions. But the last couple, or I guess the last two questions kind of go hand in hand here. So what's your outlook for the end of the year? And then what's also is your, obviously you don't have a magic ball back there or a crystal ball back there.
I
But,
do. Right?
yeah, but I kind of have my own opinions on this. So what's your outlook for the end of the year? And then also short-term outlook over the next two quarters?
Yeah. And this is going to be a cop-out answer. I try not to fortune tell. I think if you buy quality companies and you buy quality investments, you buy quality funds, and you do diversify. We're owning lots of asset classes. We own stocks, we own bonds, we own real estate, we own precious metals. We own all those assets appreciate over time. They don't all appreciate the same rate. And that's the beauty behind diversification. So I try not to be the fortune teller. I try to own quality assets that appreciate over time. And I just let that take care of itself.
Yeah. And I think like a market outlook and what I'm doing with my personal investments are not the same thing. So like my strategy doesn't change based on what the market's doing. But as far as my opinion on what the market's going to do, obviously all the disclaimers on this, I have no idea. I have as much idea as the next guy, but I would anticipate some more short-term volatility and maybe potentially some more short-term drawdowns. Just because I mean, some of the technical metrics that we look at shows like a lot of negative momentum. So I think there could be some short-term drawdowns, but long-term, I could actually see a lot of people realizing that a lot of these stocks that are selling off are cheap, and I don't think I might say that the market is probably going to either, as of where we are today, either finish up from here or around this level. I don't think it's going to be a year where the market finishes down like 25+% or anything like that.
Yeah. We're going to hold you to that, Derek.
Oh, please, yeah, yeah,
yeah. So guesses are fun, but I think
the strategy shouldn't change.
Yeah, the strategy: buy quality assets and hold them for a long period of time.
Yeah, I like it.
So I think Derek, we're running out of time here. Is there any other last question here that we need to get in?
No, those were the only ones that I had. But like we said before, we're gonna do this again, hopefully on a quarterly basis. And thanks everybody for joining. This was a good turnout. I appreciate everybody, and have a good rest of your week and stay the course.
Thank you, guys.